We were just talking just in some of the news. I mean, you've been, not to mention your experience rather than your age, but you've been around the financial industry for a long time.
Kind.
You've seen the changes. We were just talking about Mike Kavanagh moving from JP Morgan to Carlyle and what that says about the changing landscape. So what are your thoughts on that?
Well, I do think it's quite interesting. Heir apparent of JP Morgan wants to go to Carlyle. Probably going to make about 5 times the money and spend about 90% less time with government officials. So clearly understandable gig. But I do think it's a prism into the changing landscape. Businesses have life cycles. So, it used to be the big global banks, and then we have these alternative investment firms, and now they're getting awfully big.
Right.
And institutionalized. And so I think the implications for us at UTIMCO is, we try to find or establish some type of competitive advantage. And on the one hand, we're not ultra high net worth family offices. On the other hand, we're not state pension plans or sovereign wealth funds. So I just think it's instructive to be mindful of the landscape out there.
Right. You mentioned, I think, I don't know if you meant it to be on the record or not, but you said all fees are too high and all fund sizes are too large. I mean, I'm sure you were generalizing, but I mean, that's something you have to grapple with as you try to select your managers, right?
Well, absolutely. And it gets to alignment of interest. As funds get larger, the management fee becomes a higher revenue stream. The way we think about it is there's really only one religious question that needs to be answered, which is what should the most senior guy take home regardless of investment performance? If we can agree on that number, then it's not that hard to reverse engineer an investment management firm, front office, back office, big dogs, medium dogs, little dogs, overhead. And
so what's that number?
Well, if you're in New York and you think the top guy ought to make $1 million regardless of investment performance so he can have a nice house and send his kids to a private school, then actually that number works out to around $750,000 of management fees per full-time equivalent employee. Most of our managers are a little higher than that, but we have some managers that are much higher than that. And that's when we think kind of alignment of interest becomes a bigger question.
Right.
We're a big fan of carry, although we would tweak that model in many ways. It ought to be a European waterfall. Frankly, there ought to be a hurdle, not a preferred return, a hurdle. If it's not a European waterfall, it ought to be before tax clawback. And I can go on. So we've been active in that. And again, it gets back to alignment of interest. Like with most things, it's a function of supply and demand in all markets, particularly in capital markets. And again, this goes back to fund sizes. Our challenge is our job is to identify talent, and our challenge is to identify that talent before others do, because then we can be best aligned.
Right.
And kind of one step ahead of what we see as our competitive set.
Do you find that, I mean, I'm sure it's case by case, but on average, fund managers work for you within your criteria for a few years, then you have to change and churn because a factor for you?
It is case by case. Greed is an awfully strong emotion, and so we do find managers that, I think the phrase is you go from an investor to an asset gatherer.
Right.
That's not always the case. Let me give a shout out, for example, to Ellie Simmons at SCF, who is, in our view, unquestionably the best private equity investor in oilfield services, and has been for 20 plus years, 30, I don't mean to age Ellie, but he stuck to his knitting, raises $150 million funds. Now, my beef with LE is that we, UTIMCO, were his, I think, largest initial investor, and we still are, but he won't give us the entire fund. So, there are examples of what I'll call good eggs, and then there are plenty of examples of others. And again, we invest with a lot of large funds. At $32 billion, we kind of have to.
Right.
And so, for example, we invest with John Gray at Blackstone Real Estate. Why? Well, first of all, we just have a very high regard for John and his team. Secondly, with the demise of Mesref and Lehman, it's pretty, John's in a fairly attractive competitive position, we think.
Right.
So it's case by case.
Okay, let's just back up a second for everyone here. So 32 billion, something like that. How, and I think at least by endowment and pension standards, pretty high proportions in hedge funds and private equity. So just give us a quick rundown of that.
So let me break the 32 billion down just a little bit. A couple billion is the checking account for the University of Texas system, which is a $16 billion a year revenue / expense organization. And so, nothing too fancy there. 24 of the 30 is pure endowments. About 17, 18 is for the benefit. All of the endowment money, the UT System Board of Regents is the fiduciary, but about 6 of the 24, Texas A&M system is the beneficiary. So oftentimes you'll read, in case you do these things, that UT is the 3rd largest endowment, pretty close with Stanford and Princeton. That's true, but the total endowment money we run is 24.
Right.
The remaining $6 billion is not the checking account, and it's not endowments. I only mention it because we don't put private investments in that $6 billion. So, but we do have about 1/3 of that in hedge funds. So, and we have about 1/3, 30% of our endowment money in hedge funds. So we have about a $9.5 billion hedge fund book. We have about 27.5% of the $24 billion endowment money in private investments, right, from credit to real estate to natural resources to buyout to growth to venture capital.
Right. And I think you refer to it as a fund of funds model. I mean, would you ever manage any of that money sort of in-house? I mean, you're big enough to do that, right?
Well, so we do manage about 2 or 3% of our assets in-house in a fixed income book. We've got a couple of guys. They do a great job. They also oversee our external fixed income managers, number one. Number two, we are doing more co-investments, not direct investments, but co-investments. I think we've done $600 or $700 million of commitments in the last couple years. Before I got to UTIMCO, there was a period of time where there was an in-house REIT manager, did very, very well, and left. We are not averse to having internal investment teams if one, came over the transom. We're not actively seeking it. Harvard, for example, is a very large in-house hedge fund. Our starting point is that skill matters in our business. And, we are not convinced that we can have all of the most talented people in the world, working on the UTIMCO payroll directly. Our compensation model is like most endowments. Nobody's crying tears for us, but at the same time, we don't make as much money as you guys in the private sector. but we're mission driven. Austin's not the financial center of the universe yet. Britt Harris is there, so wherever Britt is, it is the center of the universe, and he's convinced that he'll make Austin the center of the universe. But it's an attractive place to live. And you know, it's not one of those things that we rule out, but it's not something we're actively pursuing. You know, our view is that if we want exposure, for example, in Brazilian public equity, we want to partner. We want our money managed by the best Brazilian stock picker we can find. And our thesis is that those individuals are probably located somewhere in Brazil.
So how do you, whether it's Brazil or anywhere else, how do you go about finding them, selecting them, and then getting past these other issues we were just talking about, the asset gathering or versus...
We travel a lot. We travel a lot. And we're not in a rush. We're long-term investors. So, for example, when I was at Citigroup with the pension plans, you know, we traveled a lot. And I started going down to Brazil once or twice a year. 7 years ago when I got to UTIMCO, I said, hey, we ought to go to Brazil, you know, check out Brazil. And so we'd send 2 or 3 colleagues at a time for a week, and we'd have 2 or 3 waves going out every year. Well, you know, again, just using Brazil as an example, you know, we think we have some idea of the politics, the economics, the government, you know, the regulations, and the capital markets, and some sense of the investment management community.
Right.
And you know, we again, no rush. We just kind of continuously, we try to be disciplined. We try to be counter-cyclical.
Right.
And you know, that's how we approach things. Right. And you know, we think networks matter. You know, we kind of, you know, in Brazil, as in a lot of, you know, communities, the investment management community, you can trace back their origins to the large banks, right?
Right.
And so, you know, there's 3 or 4 large banks, and you kind of see where people go, and then from there they go, and from there they go. And so, you know, we try to understand, get to know the network. And as long-term investors that try to really try to get to know our partners, you know, view it as a partnership, hopefully we gain a good reputation as an investor of choice.
Right. So let's talk about performance a little bit. I mean, you aim for a sort of low risk, and therefore you risk adjust the benchmarks and so on that you're trying to get to, and you beat those by a couple of percent, I think, lately. But you may fall short of what some other endowments do, and you're happy with that.
Well, so our basic objective is to make what the regents take. So if our clients, again, the regents, UT System Board of Regents, and you know, actually the A&M regents aren't the legal fiduciary, but we understand clients, they're a beneficiary. And so if their distribution rate's 4.75%, we're supposed to make that plus inflation to keep the corpus whole in real terms. And we measured that over long periods of time. 10 years, and we've been doing that, and so that makes us happy, makes our clients happy. I should say, makes our clients happy, makes us happy. Check. We do measure our actual returns versus benchmarks, target allocations, you know, indexes, because my colleagues wince every time I say it, but the reality is the UT System Board of Regents doesn't need a fancy UTIMCO. They could invest at target passively. And so I think we should, and we are measured on how we do versus those passive targets. And,
right. I mean,
you know,
David Swenson used to say, if you don't have the people and the skills to pick the best managers, you should just use index funds.
Absolutely, right? Absolutely. And whatever David Swenson says, you listen to David. He doesn't always tell you everything. If you read his book, he never said put 25% of your portfolio in real estate. But when he does say some things, you should listen to him. Look, David's the best, right? And so and our incentive compensation is based on our actual performance versus those benchmarks. And we're capped. There's a maximum. We have to, we have certain targets, et cetera. And we've done between target closer to maximum for any number of years. So that's a check. There's nothing in the theory or the law that says we need to do as well as all the other endowments, but human nature is human nature. And so, a few years ago, and when we were one of the top returning endowments, everybody puffed out their chest. And, the last couple of years, frankly, we've been, our actual returns have been lower. Now, there's some structural and tactical reasons for that. The structural reason is, I mentioned 27.5% in private investments. That's actually very low for large endowments. The average is more like 35, 40. Some people have 60%. When I got to UTIMCO 7 years ago, I think we were at 12 or 15%. And, we could go into the secondary market and buy a ton of private investments. I'm not sure that's the smartest investment to make. But we are gradually, we think as a long-term investor we can handle illiquidity risk. We did a lot of work on it as to how much we could handle, but also how much we need to return, and do we think we can return that. And particularly in areas like natural resources, real estate, emerging markets, we're expanding our book. We have 30% in hedge funds. That's a lot of hedge funds relative to other endowments. So we have some of the lowest amount of the most risky investments, the highest amount of the least risky investments. We are fairly low risk compared to other endowments. So it's not shocking that over the last 3 years where risk has been rewarded, don't fight the feds, US, Japan, ECB's getting with the program, right? That structurally has put us in has delivered lower absolute returns than a number of peers. We also, think we're in a long-term workout. A lot of investment opportunities, but we want to be really cautious in that. So risk-adjusted returns, we do better, but most people don't want to talk about that. But again, if when I think, when I was at Citigroup, the word that came down was that Sandy Weill said you should return 10% every year, the better of what the market did, or 10%. So if the market was up 20, you needed to be up 20. If the market was down 20, you still needed to be up 10. So we need to make what the regions take. We want to beat our benchmarks to validate our existence. And we want to keep up with the other guys.
Right. I think I said to you before, I like the idea that in your annual letter you kind of try to isolate, the return or overall underperformance that comes from what you and your team decide in terms of tweaking your allocations to different asset classes. Maybe talk a bit about this, and also how much of your performance or underperformance or outperformance you attribute to the active managers as well.
Yeah, our skill set is in identifying, diligencing, selecting, monitoring, partnering with active managers. And, pretty consistently we'll deliver 200 to 300 basis points of alpha across the portfolio doing that.
And that's the manager.
That's finding, investing with Mark Lasry or David Rubenstein, because we think they're the best in what they do. What everybody likes to talk about is, should I go into the stock market? Should I go into the bond market? And this is where we really don't think we have much of an advantage. When I first got to UTIMCO, one of the first moves we made off our targets was we really did, in about 07, 08, reduce public equities. We put the money in credit-related investments, both private and hedge fund, a little bit of public. Well, that worked. Brilliant, right? Another thing we did was we bought some gold, and we did it because as we modeled our portfolio, we would do fine in making what the regents take, except if there was a very inflationary type scenario. We weren't well hedged or protected there. And so we bought some gold. And our average price was, and that wasn't our target, it still isn't in our target. Our average cost was about $1,200 when it was up at $1,800, $1,900. We were brilliant. Yep. You know, back, we didn't sell because, again, we're not convinced we're done yet. At 13, whatever it is today, you know, we're not the smartest guys in the world. Fine. A second thing we've done was we really did take risk off a few years ago. Now, in part, the UT system and A&M systems benefit from owning 2 million acres of West Texas land that produces a lot of oil and gas royalty revenue. That's what comes into the funds we manage. As a UT system regent, you know, they don't think just about UTIMCO and investment returns. They think about the total sources of revenue, whether it's tuition or state appropriations. And so, given the economic capital markets concerns, you know, the idea was, hey, investment guys, first and foremost, protect capital because, you know, we've got pretty good revenue streams. So, and we were nervous, and so, you know, we did some risk-off kinds of things. And, you know, obviously that was the wrong call. You know, 7 years into it now, we're about break even on those brilliant, big tactical moves. So our lesson is, you know, why do it? What we try to say is we're going to tactically allocate at extremes. But that's just hard to do. And again, it's not clear that we possess any great insights. Our greatest advantage is as a long-term investor. And so if a market's out of favor, that's probably a pretty good time for us to go in.
I want to ask you about that again, but after that, maybe if anyone else in the room has questions, we can open it up a little bit. So long-term investment, I think you've called yourself an in perpetuity investor.
We are.
You can,
unless I lose all the money.
You can deal with illiquidity. How do you, what's that worth? I mean, how do you quantify what that's worth? I mean, is there a number on that?
So we did a lot of analytical work on this last year. When we were done, someone told us about I think a Columbia business professor who had done all the work. It's like, oh God. So, you know, we grabbed what he did, and
you have the same answers.
We got to roughly the same answer in very different ways.
That's
so,
good.
You know, could have saved ourselves some work, but you know, we think we learned a lot. The way we think about it is, what do we need to be compensated for taking on illiquidity risk? Because we always have a more liquid investment alternative. If we want credit, we can do high yield. If we want, you know, venture, we could go into NASDAQ type things. If we want emerging markets, there's emerging market public equities. And so, what do we need to be compensated for our illiquidity risk? One of the first things that we concluded was illiquidity risk is not illiquidity risk is not illiquidity risk. So for example, in a credit, the illiquidity is maybe 3 years, weighted average life, whereas in venture, maybe it's 9 years. So you almost think about it as a yield curve, that the longer the duration of the illiquidity risk you bear, the higher return you need. Then we looked at, for example, so how much per year, if you will, do we need to be compensated? And one of the ways we went about it is we looked in our hedge fund book, and where part of our hedge fund book is pretty liquid and part of it is less liquid. And on the less liquid stuff, we are in fact earning about 1% a year more. And so, you know, first rule of thumb is, okay, 1% return for each year of illiquidity. Now, you know, again, we think that it's not a straight line. There's kind of marginal return, you know, marginal benefit. But in addition to that, There's tail risk around that average, weighted average life. If it's not as long, that's fine, but if it's a longer, we want to be compensated for that. And then we also need to keep capital more, for unfunded commitment calls, more liquid than if we didn't have the unfunded commitment calls. So we added, you know, built that up.
There's a cost to that.
And so, you know, we think we need to earn anywhere from 3 to, 8 or 9% over the liquid alternative, depending upon the weighted average life. Of course, when we finished the analysis, I told my board they didn't need to worry about it because I've never had one of my investment officers bring me a deal, an investment that wasn't going to earn at least 40%. So we're always going to beat that hurdle.
Okay. Now, do we have any questions in the room? Do we have mics or? Speak loud. How about that? Yeah, I'll repeat the question.
I was just interested in getting your thoughts on the venture asset class and where you think it's headed. And
again, we don't think of ourselves as a low-risk investor per se. I should correct that. We do have a very diversified portfolio. In fact, one of the crown jewels in our portfolio is our IT venture capital book. We were some of the original and remain some of the largest investors in folks like Union Square and Foundry. If you flow our investments through, I think we are one of the largest non-inside owners of Twitter. It's a really interesting story to me because a couple of my colleagues who were at UTIMCO before I got there, back in about 2000, they were 30-year-olds, and they realized that UTIMCO missed the first round of venture investing in the 90s. So we're not in the Sequoias or the Kleiners. And so Mark Schoberg and Linda Leckman said, well, how do we compete here? And this is where, being a long-term investor, I think, helped. They kind of locked themselves in the ivory tower and said, Internet 2.0, web-based models, networks, social networking. And then they went out and said, who do they think will be the best there? And, where they figured they, met the guys at Union Square and Foundry and others. And and it's one of these virtuous circles where success breeds success. Everybody likes Lyndall, and everybody liked Mark. I asked Mark to go over to head of our real estate. We needed someone to run our real estate business, and I wanted to kind of give him more opportunity. And as I love to tell my real estate friends, if he was able to figure out venture, he can figure out real estate. So we're kind of an investor of choice now. I'm having lunch with a fella here who's really early stage venture. And, we got put together because, we run in the same crowds. I mean, literally Lyndall jogs with the folks at Foundry. And, so we're part of that network. It's a very virtuous network.
Connections matter again.
Yeah.
I can root. Yeah.
No one's ever accused me of being eloquent, by the way, so it's a good day already. I'm flattered. Ask anything you want.
So, in the same way you spoke about an illiquidity premium, and you said, look, we want to get paid for that. Right? Many of us here in New York would love to pay some kind of premium to not have to be with all of these regulators, right? To find a strategic partner. You also mentioned this scenario where you're most interested in smaller managers that have smaller funds. So my question is, what is your philosophy on seeding
just to repeat a little bit, it's really a question about UTIMCO's approach to seeding new funds to help them sort of deal with the government stuff and.
Right.
And
By the way, I do believe there's a role for government. I do believe it needs to be regulated. It's hard to get things just right in life in general. It's hard to get things just right. Our biggest challenge to seeding is $32 billion. Is a $9.5 billion hedge fund portfolio. By the way, we've got about a half dozen people from analyst to MD that manage that for us. That's the challenge. We do seed, but not people coming over the transom. I mentioned the Brazil chart we have. We have a hedge fund genealogy chart. Again, my colleagues had nothing to do with me, just nailed it early on with all the guys that left Bob Rubin's shop. So we were some earliest, largest investors with Perry and Dan Ock and Farallon, et cetera, Blue Ridge. And then there are others. There's, you know, the Tiger contingent and whatnot. So what we find happens is when Tom Steyer brings down the equity book at Farallon and Bill Duhamel decides to set up Route 1, well, we've known Bill for 10 years. Because, again, we don't just try to do diligence on our managers up to investment time. You know, I'm visiting I have 13 manager meetings this week. I think 9 of them are existing managers. And my colleagues don't like me to get in front of their managers because I'll screw up their relationship or I'll front run them and for sure I'll embarrass them. But we really try to know our managers and they know us. So we're Bill's first call. When the guys spin out of Blue Ridge, right? John Griffin will call us up and say, he's a good one, take his call. And we know them, and so, you know, it's generally, we have the same view. So, in fact, and our hedge fund portfolio is a top decile performer over long periods of time. But, you know, at some point, Danny Ock and Richard Perry, they're getting older like me. And some of them are building, you know, shops that'll continue. You know, when Tom left and Andrew Spokes takes over, we know Andrew, we have high confidence in Andrew. We, you know, haven't redeemed a dime, you know, we haven't missed a step. But partly kind of the challenge is to find the next generation of great hedge fund managers. And we presented to our board a meeting or two ago where over the last couple of years we have, we call them next generation managers. We have about 40 managers in our portfolio, hedge fund portfolio. 14 of them are in this next generation basket. Now, you know, almost all of them either came out of a shop we've done business with or a shop we don't do business with for whatever set of reasons, the Children's Investment Fund, but we know there's good people coming out of there. What we tend not to do is the person coming out of the big bank prop desk, because we just don't know them. Now, you know, there are people that are really good at that, Protege, Reservoir, Blackstone, I mean, it's their business. DUMAC does that. I was on the board of DUMAC, and I have a high regard for Neil Triplett, and they do that. I think they're doing well by it. And that's one of those things we talk about, we think about. My colleague, Kathy Iberg, you know, has been in charge of the hedge fund book forever, and I'm always saying, are you looking for something new to do? Do you want to do that? But it's, the question is, again, what makes us think we'll have a competitive advantage there? Vis-a-vis our network of relationships, we're, you know, our biggest concern, you know, is that we don't get as much capacity as we want with, you know, some of these guys that spin out of these shops. But they need to run their business as well. We understand that.
Okay, if you can make it really quick, that would be great.
Yesterday there was a mention about management fees as the most negotiated term in private equity and hedge funds. And we also heard David Rubenstein saying he took the pledge to give most of his money to philanthropy.
I'm sorry, I didn't hear what David said.
David Rubenstein said he took the pledge to give money to philanthropy.
God bless. God bless.
Most of the managers who are making so much money come to you and say, we're going to pledge our money to philanthropy. Would your negotiation on fees not be as technical?
No.
So
No,
the
no,
questions
go ahead.
about philanthropy, and David Rubenstein made the giving pledge, and whether Bruce's negotiations with managers would be different in any way if they had made philanthropic commitments, I guess.
They can do it much more directly and quickly by having reasonable management fees rather than go through the whole chain.
That's the
you know,
kind of
life
philanthropy we
cycle.
like, right?
And again, you know, I'm pragmatic, I think. It's supply and demand. And by the way, we've got small private equity partners in emerging markets that may charge 3 to 4% management fees, and we're happy to pay that percentage because they have very small AUMs and very large teams. And I don't mean they, you know, hire a bunch of administrative assistants. These are operating, you know, partners and that kind of thing. So you know, it's not the percentage. Again, it gets to, you know, alignment of interest. And I will tell you, some of the most egregious, I use the word egregious, are some of the energy, my good buddies down in Texas, some of those big energy funds, because they're so darn good. They built such a successful model that they have a fairly, you know, they don't need a ton of staff, because what they do is recirculate management teams, re-up with, you know, management teams, so they don't need a large staff. Incredibly successful, tons of AUMs. So if you do the calculation there, it's just a victim, you know, they're just incredibly successful. And again, kudos to them. And we've made money alongside them, but we just, you know, just wonder about alignment of interest. And partly, and so again, it's supply and demand. And that's where I think our job is to identify talent, and then if we can identify talent before others identify that talent, that's where we'll, you know, have the greatest advantage. And we don't want pieces of GPs or anything like that. We just want guaranteed capacity and you know, a good alignment on economics.
Great. Bruce, thanks very much.
You're welcome.
Indeed.
Thank you.
For
all righty. Thank you. Thank you.